today, right here, right now, this is the moment that you'll finally say, I'm growing my accounting practice. And you're going to discover exactly how right here, right now on the Grow My Accounting Practice podcast, episode 105. That's right. Welcome to the show. I'm joined by my buddy, the Haludge.
How's it going, everyone?
That's Hawaiian Lumberjack. He also goes by Mike, but he prefers the Hawaiian Lumberjack. If you saw his full lumberjacky beard, you'd get it. And you, my friends, you're listening to GMAP. That stands for Grow My Accounting Practice. This is a show where we teach you the step-by-step how to grow your bookkeeping or accounting practice. And we give you an action tip that you can take action on right now at the end of the show that will guarantee another step forward in growing your accounting practice. It's the only show on the entire web that does that. 106 tips will be today. Can you imagine if you did all? Your practice would be huge. And there's so much more than that. We have the psychology of the sale. Now, actually not today because Ron is still on a little vacation out and about. But we have constantly these powerful tips on the psychology of the sale. And Ron's going to bring him back when he comes back from vacation. And we also have a great guest that joins us for every episode. Win, win, win. Oh, by the way, where can you find us? Mike, where can people find us?
I think people can find us on iTunes.
That's right.
Stitcher.
Yes.
TuneIn Radio.
Oh my gosh.
GrowMyAccountingPractice.com.
Yep.
.com.
Yep. And Google Play. You got to jot that one down in your notes. We're now on Google Play, you know. Exactly. So go to any of those podcatchers. You'll find us there. Subscribe. If you go to GrowMyAccountingPractice.com, that's our own website. You get the top 10 greatest hits. It's like your favorite album. I know you were a big Def Leppard fan back in the 80s. Maybe you're a Judas Priest person. Maybe you were into Rick Springfield, Jesse's Girl. Whatever you're into, don't you want the top 10 hits? Of course you do. Well, now you can get the top 10 hits of Grow My Accounting Practice just by going to GrowMyAccountingPractice.com. Oh, one more thing. We got this whole bonus thing going on. If you send a text, a real simple text, GMAP, that's G-M-A-P, GMAP to 678-506-7543. That's 678-506-7543. Just send the text GMAP, and guess what? You get free access to our monthly webinar series. No longer do you have to pay. I mean, other people do, but you don't if you simply text GMAP to 678-506-7543. So do that now. Before we kick off with our wonderful guest, Nancy Greene, I do want to tell you about our corporate partners. Who are they, Mike?
Nextiva.
Yes.
Fundera.
Yes.
Fundbox.
Yes.
And Receipt Bank.
Yes. Thank you to all of those wonderful partners. We'll give you more details about those folks somewhere toward the end of the show. And I think they'll be perfect for either your firm to use or for your clients to use, or perhaps a combo 1-2 deal. Her name is Nancy Greene. She's principal at Land, Carroll, and Blair PC. They were founded back in 1978, and they virtually handle every aspect of civil and criminal practice law from their Virginia offices. Nancy worked primarily with women owner businesses in two phases of those businesses' growth, which is the startup and the transition to legacy, where you have to create an unstoppable back office operation. A couple of things you may or may not know about Nancy. If you haven't met her, you may not know that she is the published author of Navigating Legal Landmines, a practical guide for business law for real people, that was released back in February of 2017. She's a partner, as I said, at Land, Carroll, and Blair. And recently, she was handling an employee embezzlement case where the court deemed a lien was appropriate against the defendant to take possession of their house, or lien against their house and their other assets before a trial kicked off. That doesn't happen too typically. And, well, Nancy, first I want to welcome you to the show, and then I want to learn about that. So welcome to the show.
Thanks, Mike, and thanks, Mike. Thanks for having me on GMAP today.
Oh, it's our pleasure. Our pleasure. I got to learn about this case. You were able to get the court to, I guess, I don't know what the term is, deem a lien, to render a lien against a defendant. Can you tell us some of the details of what happened there?
Sure. My client was a restaurant and wedding venue area, and it had a contract bookkeeper for a number of years. And what we learned earlier this year is that she had gone in and was writing checks to herself and using the rubber stamp to cash them. And then she'd go into QuickBooks, and delete those out, add the amount to the tax payment, so that the QuickBooks file looked like it balanced when she was doing a really good job hiding all of it. And we had before we had trial, we had over 100 checks that she had made payable to herself and cashed.
Oh my God. How much money did she steal total?
We're still working on that, but we're thinking the number's in excess of $400,000 at this point.
Oh my gosh. Sadly, this is not the first time I heard a story like that. We did an episode. We have a sister show called Profit First Podcast, and this company came on, and they had something to a similar tune, $400 to almost $750,000 stolen from them. Similar case. It was a bookkeeper, and the guy, he called and he said, "You know what? I did Profit First without even knowing it. I had all this money embezzled from me. I still ran my business profitably, and then he recovered every penny and went right into his profit account." So, not that, sometimes there's something hidden in a dirty story like that. Hopefully, it comes out positively for your client. I hope it does.
Yeah, well, and that's sort of what we're hoping. So we went to the court with that information package and asked them to do a pre-trial, prejudgment attachment of the defendant's assets. And because we were able to put such a strong showing that she had taken a lot of money away from us, the court did grant us that, which gave us a lien on the 2 houses she owned, as well as all her personal property, her vehicles, the stuff in the house, everything.
Yeah, it's wonderful. So hopefully your client, justice will be served, is what I'm hoping. But talking about law, that's what our focus is today. When it comes to growing an accounting practice, a lot of business owners go into business with another business owner. It's good to have a shoulder to cry on. It's good to go into business together and support each other. Maybe hopefully you do compliment each other. And there's a lot of rah-rah and high-fiving in the beginning, but sometimes it goes sour. What's your experience with that? Do things go sour? And then, of course, the whole conversation is what do we do to prevent that from happening?
Yeah, I've definitely represented far too many businesses where the business owners got in together and they were friends of friends or friends from colleges or the husband's friend who was recommended to go into this business, and they jump in all happy and excited and they don't slow down and do some of the things they need to do. And then months or years later, there's a problem. And one of the biggest problems with that is, the business partners, it's like any other relationship. And at least if you're going through a divorce with a real partner, the court has some rules as to how that works out. And if you're going through a corporate divorce, a business divorce from your business partner, the court really relies on you to set those ground rules. And if you don't have those ground rules in advance, likely the only thing the court can do is dissolve your company, and everyone loses when that happens.
So, yeah, clearly. So let's go through, first I want to go through the structure of setting up a good business partnership for an accounting firm or a bookkeeping firm or any kind of firm, I guess, from the get-go. And then I want to discuss what do we do if we already have an established firm, because I think that's the case for most of our listeners. But if you could get all your wishes, Nancy, and get a business set up properly from the get-go, what's the actions that you would take?
So I'd have those business owners go out and meet with an attorney and go through a lot of the really hard questions. So I've got a 4 or 5 page outline of things that business owners should have in their shareholders if they're corporations, or operating agreements if they're LLCs, about the kind of issues that come up that really the parties should be thinking about in advance, like what happens if one of you dies? Do you really want your partner's kids or spouse to be inheriting the business, or do you want to be able to claw that interest back and pay out to the heirs of the dead partner an amount that's fair? What happens if someone's disabled? What happens when someone doesn't show up from work? What happens when someone embezzles? All of those things, all those very uncomfortable discussions really need to happen in advance when possible. And that's why having an attorney or someone to facilitate that, it's not that you're looking at your partner and saying, I think at some point in time you're going to mess with me, so I want to protect myself.
Right.
That's an uncomfortable way to have that conversation. But by bringing in that third party, said, look, here's the deal. These are the questions I'm going to ask you. And I'll go through that process even when, and especially when really the parties that are going to own the business are husband and wife, to find out whose business in that situation it really is, who's got control of which areas. And if there's 2 of them, how do you break a deadlock? If one partner says yes to an opportunity and one partner says no, technically the company can't go forward, right? Because you don't have a vote. You're deadlocked. And how do you break those deadlocks?
All right. So I want to go through these and get your best practices. Let's first talk about the husband and wife. That's a pretty common scenario. The wife starts an accounting practice. Husband has a full-time job. Accounting practice is growing, brings the husband in. They decide to split the equity 50-50. Maybe a guy starts a business and says, hey, it's an advantage to be woman-owned. Why don't you own 51%? I'll take 49%. But that's more in theory, not in practice. Is there a best practice for managing a business partnership or structuring it in a way to set yourself up for success when you're already married?
It is. There's really, you go back to that fundamental question of, okay, whose business is this? Who's the one that's the driving force for that? And you can put in provisions that say, okay, let's say it's really the wife's business and the husband's brought on later to support it, or he's got the full-time job and he's just doing the funding. If there's a problem in the marriage, you don't want the business to go down in flames. We actually had that case where it was the husband's business, the wife was the other 49%. The husband was having some psychiatric issues and ran away. And the wife,
really?
Yeah, some really bad psychiatric issues. And the wife started bringing a divorce proceeding, and the divorce judge was trying to exercise control over this company, put in the wife's new board, which she didn't have the authority to vote in. We ultimately filed the very profitable company for bankruptcy to protect it from the divorce court because they didn't have this type of agreement. So you want to be able to set up, if there's a trouble in paradise with the marriage, you want to be able to have a separation. And sometimes that looks like the spouse whose business it isn't loses their right to vote on control. They still own it. They still are entitled to get paid out according to the agreement or what the divorce court decides, but they then can't fight over control.
Gotcha.
And that's one way to keep the business going.
Gotcha. The other thing you mentioned is how to break a deadlock. I want to know best practice around that. So that's the old 50-50 ownership, and both sides or the sides disagree, and now the business is deadlocked. What's the best practice in preventing that from happening?
There's a couple ways to get around that. The first is really looking at which partner is the expert in which area. So if you're the expert in bringing in new systems and bringing on new people on the management side, then you should ultimately control that decision. If the Hawaiian lumberjack is the finances guy and he's saying, no,
yes.
We can't do this, then his no should win. So you've got to look at those areas of expertise and control and possibly delegate them out. And sometimes if you can't agree, I like putting in dispute resolution provisions so that when you don't agree, you have the opportunity to bring in a third party who acts as a mediator or sometimes the decision maker, so that you can get past the deadlock. And again, you don't destroy your business while you're having a disagreement.
But up front, say Hawaiian Lumberjack and I decide to go into a lumberjacking business. And Hawaiian Lumberjack is like, dude, I know everything about lumberjacking. It's been in my family. I'm the 10th generation of Hawaiian Lumberjacks. And Mike, you know nothing. So it's best that I make all the decisions. Well, yeah, Mike is great at swinging an axe, but he may not have the business acumen or may not have something that I may have. But both of us may be clouded. What if we go in with an assumption of something, but 6 months later or a year later, the realization is something different? Are we set in stone here when we make an agreement, or is this something that's flexible?
So the really good thing about them is they're not set in stone, assuming both parties can still agree.
Gotcha.
Right. So if you get into the business and it's Mike and Mike's, lumberjack shop,
Yep.
and
I like that.
The Hawaiian lumberjack comes back and says, I thought I had this whole how to manage people thing, and I really just want to be out in the field swinging an axe. So you handle this for me, Mike. You can go back in while you're both agreeing and amend and change that document. And it's probably, when you start with these foundation documents, you probably want to go back and look at them, even if there's not a specific event that makes you think about it, at least every couple of years to make sure they're still really what you're doing and really what you want to be doing.
Now, what about, oh my God, it just slipped my mind. So I'm going to go on to the next. I had a great question and it slipped my mind. So what about if you can't remember questions? Well, actually, that does bring something. What if you forget something? Meaning, I assume it's the same thing, but we put this agreement together. We have your guidance. We think we nail everything. And then this anomaly comes up. It's like, oh my God, we never addressed it. What if new stuff comes? Is it the same circumstances that we can just add it on? Or does common law take place? Or what's the situation there?
So if the agreement doesn't specifically talk about it and it's silent, it's going to fall under what general practices are and what the law is going to apply, assuming, again, you can't agree. If you and Mike can agree about what to do, then you can go back in, change the document to cover it. But if your agreement is silent, it'll either go to, like if it's a management decision it's silent on, then you might end up in your anti-deadlock provisions because no one has designated authority on that particular aspect. And sometimes if you just can't anticipate everything and it's not there, then you may have to go back and look at what the law would actually say in that case.
Okay, and if a new business partner is brought on board, can you just add to the agreement?
Yes, and I've done that for clients before. So I had a aeronautics company that started many years ago, and over the course of its life, it's had partners come and partners go. And every time it brings in that new shareholder, that new member, that person has to sign off on the operating agreement, or in that case, it's a shareholders agreement, to say, yes, I agree to be bound by these rules. And if they won't sign off, they don't become part of the company.
Okay. Now let's go into what I'm particularly curious about is an established business. I think there's a lot of people listening here. The business is already established and they already have partners. It was a handshake deal. Like, hey, let's go do this. I assume it's never too late, but is it strategically a bad move for me to go to my partner of 4 years and say, you know what, we never put together a legal document, our partner's agreement. I think we should do that now. Do I have to be prepared for some pushback or something from a strategic vantage point first?
If there are problems, right? If there's already trouble in paradise, you might get some pushback,
yeah.
right?
Yeah.
But for the most part, most business owners, when they start, they're cash poor. They're hitting the ground running. They're trying to get stuff up and running, and they know getting all their legal house in order is something they have to do down the road. And so when you have that discussion down the road, it's possible to, oh yeah, now we've got a breathing room and now it's worth spending the time and energy to think about planning for the success of this business, planning for our retirement. What are we going to do? That kind of makes some sense. There's also times when events in the news or, cocktail hour stories, flag the nightmares and you go, I was just talking to, and they were talking about this and we really need to make sure that doesn't happen to us.
That's actually a really good idea.
There are lots of ways to approach it.
Yeah, that's a really good idea. So I can pin this on the news and saying, this will protect us collectively. So I love that. Say my partner agrees. What's the next step? Do I say, hey, I know a lawyer, Nancy Greene, she'll take care of us. And my partner's like, no, that's not my lawyer. We should go to so-and-so. Do we need to agree on a lawyer for something like this?
You really need to have a corporate lawyer who's going to draft it. And then the corporate lawyer is looking out for the best interest of the company. And as long as you and Mike agree in this case, then that's fine. But if you and Mike are disagreeing about parts, there could be up to 3 lawyers involved, one looking out for the best interest of the company, which the law crazily thinks is a person, and one looking out for your interest and one looking out for Hawaiian Lumberjack's interest. That's when it kind of it's in that sort of nasty phase, and that's likely that you're not going to get those disputes resolved. But generally speaking, working with an attorney who becomes the corporate attorney who says, these are the issues I think you guys should be considering. Go have a discussion amongst yourselves. I don't need to sit here. You don't need to pay me as a lawyer to sit here while you talk about it. And come back with me with what you agree to. And any points we need to talk about more. And then the lawyer can document those agreements or help you work through what makes the most sense if, one of you wants your stock to be inheritable and one of you doesn't want that to happen.
So I want to go through the stock component and actually all the components. So say I get my partner to agree, we decide, we'll just use one lawyer. What are the key elements that we need to agree upon to put in my business? Now, I know we can't cover everything here and have 100% buttoned down sealed, but what's the big 80%, if you will, of things that every agreement should have addressed?
You want an out clause. You want to have the ability to gently move a partner along if things aren't working out. and they go, both ways, right? But if you've got a non-performing partner or there's bad conduct going on, and most of the time it's usually there's a non-performing partner who's decided that, I'm retirement age, I want to go sit on the beach and drink Mai Tais and not work my butt off.
Yeah.
How you address that. So the buy, sell, or out clause provisions are probably one of the most important things you can have in those kinds of agreements. And that includes things like what happens if someone dies, what happens if someone's disabled, and then those control provisions as to who's got what say, who's really kind of in charge of making those decisions are also pretty critically important.
Okay. So let's talk about the buy, sell, out clause. What are the basic guidelines for that? Do you have to put a valuation on? Think about it. The people listening to the show, we're mostly small accounting firms, small bookkeeping firms. What do we have to do to have a good or well-structured but fair buy, sell, out clause?
Usually you're looking at trying to create some sort of formula that's your baseline, right? That either looks at, and actually usually I try to bring people's accountants in on this discussion, right? Because they also have a sense of what the finances of the company are like. So whether that's, based on gross profit, whether that's based on gross revenue, whether it's net numbers, whether it's a multiplier, those are all things that you discuss and realize that you're setting the baseline. So if you agree that it's going to be, the net income over the last 5 years divided by the percentage of stock, for example, and the partner who's leaving is leaving on really good terms and has done a really good thing, and you want to actually pay more than your document says, then you've got that ability to agree to pay more. These documents really set the bottom line, right? So it makes it really hard to pay less.
Okay.
And you can put in sort of forced buyout provisions, right? So that, and I've done these before, but where you've got that suit where one partner wants someone else out, that they get to make an offer, but they have to be really careful about that offer, because if they undervalue the company too much, it flips on them. So the person who's being asked to be bought out could say, no, I'm not going, but I'll buy you out at that price. And you can have it so that it's forced out. So when you make the offer, it's kind of putting good faith on the table already, because you don't want a low number being flipped back on you. So that's one of the checks and balances you can put in too. And what the terms are pretty much as flexible as the personalities involved.
That reminds me that there's a childhood game. If there was a cake and me and Halaj were going to share the cake, I could go to Halaj and say, you cut the cake, you cut the 2 pieces, but I get to pick the piece I want, or vice versa. I'll cut it, but you pick the piece you want, which then forces that balance. And that sounds very similar in that financial strategy you just shared.
Yeah, it is. It's very much like that idea. It's like, if I'm going to try to mess with you, but I know that you can take my offer and use it to mess with me, I'm going to try to treat you really fairly, because I don't want to be, if it's a company worth $500,000, I don't want to offer to buy your share out for $100,000, right? Your 50% share, because you're going to go, great, here's your $100,000. Thank you very much. Go away.
Right.
So it kind of forces you to be a little more fair.
Right. Well, I heard another strategy, and maybe for an established business, it's maybe a little harder to put in place. Maybe for a new business, it's easier. I don't know if you've heard of this, where when it comes to the distribution of equity, I heard of a legal agreement where instead of you and Nancy, you and I, say we decide to start a business together and we're like, oh, we'll be 50-50. Instead of doing that, saying, we're going to earn our share. So we're both going to share in 10% of the stock. So you get 5%, I get 5% when we start. But based upon our performance, and we determine the metrics, how many hours we work, how much we sell. Each person's individual performance will earn out on a quarterly basis or an annual basis more stock. So that over 2 or 3 years, all the stock is earned based upon performance. And the idea behind this strategy is it's easy to say in the beginning, oh, we're going to be 50-50, but it's hard to fake how good we can perform for 3 years. I mean, we got to deliver. So it again speaks to what we're actually producing and not what we theoretically want to produce. Have you heard of something like that before? And even if you have or haven't, what's your thoughts around putting a structure like that in place for a business?
So I have heard of something like that. I've done that when we've brought in usually someone on the executive level that it's coming into an existing company that has the ability by bringing in more revenue to earn additional equity up to a certain cap. So maybe we bring them in at 2%, so they've got an interest and they've got an opportunity over several years to earn, up to 10% of the interest in it. And that tends to work really well because it's a pretty good incentive, right? Because the more they earn for the company, the better off they do. It would be a little more difficult, I think, on the founder's level, just because there's that, unless your metrics are really, really clear and value everything sort of equally. And that's the hard part, right?
Yeah.
You get the chance of having big debates. So maybe I'm not bringing in as much dollars because I'm out there doing the PR and the networking to get the name out, but you're the one actually doing the work. So on the revenue in the door, your numbers are better than mine, but I've added a lot of value and I've got that intangible. So that becomes really hard if it's not someone who's a more sales or growth type focus on an established business.
Okay, so the key elements of a solid partners agreement for an accounting firm or a bookkeeping firm is you have to have that buy-sell component in with the out clause. You said you have to have the control provisions. Who's making decisions on what? What other key elements are there?
One of the things to really think about for the business is its long-term development as a person separate than yourself. So what happens and who actually owns those clients, and when someone leaves, if your state allows it, does it make sense to have some sort of anti-competition provisions, or is it the Jerry Maguire, show me the money, show me the money, right? So is it a free-for-all, or what are the rules for that, and where do those clients go? Personal services businesses are tougher, right? Because generally the clients form a relationship with you who performs the services for them, and they want to follow you wherever you go. And it may be that, as a compensation to the practice for you leaving and taking that client base with you, you have to pay a royalty back for some period of time or something like that. So that may be one of the things that you discuss is what happens, breaking up is hard to do. Let's set some guidelines to that.
Gotcha. Okay. So now we have the document bulleted down. And I guess you go through also in this document all the what ifs. What if you said on the buy sell if someone dies, but what if one owner says, I'm done, I want to sell this business, I don't want to leave, I want us to sell it, and the other owner says, I don't know if I want to do this. I mean, do you address all these different what if scenarios in this document? We
try to address, again, the top 80, 90% of them. If you've got people who are, different ages coming into the business, so you've got someone in their 30s that's coming in and someone that's coming in their 50s, so it's likely that at some point one of the partners is going to want to retire. I'm done with it. I just want to get cashed out.
Yeah.
We do have that discussion, or try to have that discussion about, okay, what's that look like? It may be that the company can't pay you a lump sum when you want to cash out, or you may be the financial backer, right? I had one business where the older partner was the cash flow, and that's why they were getting loans, because of the strength of his finances. So his leaving the business to retire as he turned 70 became a real problem for the business. And again, when you have that opportunity, or when those major life events are coming up, you really need to sit down with your partner and say, okay, here's what I'm thinking, here's what's going on, how are we going to do this? Are you going to shut down the business? Is there going to be a succession plan? And all of that, and have that sometimes difficult discussion. So you have me convinced I need to get a partner agreement in place when I start my business, or even if I started, I need to get one in place now, and it's doable. My next question is how frequently do we revisit this agreement and make changes to it? My ideal, and I'll tell you, every 3 days, and I'll only charge you $1,000. It is at least every 3 years, or if there's a major life event for the business. Okay. So if the business is going to bring someone else on and it's only been 2 years since you last looked at your document, you need to look at your document. If you're going to, have a whole bunch more debt come in, maybe that's another time to go look at it. But every 3 to 5 years, you probably want to go back and touch all of your foundation documents, including your client agreements, your employee agreements, your handbooks, to make sure they're kept up with changes in the law, kept up with the way you're really doing business, and keep up with both your vision for what you want to grow and what you're actually doing.
So what would you recommend for an already established business that doesn't have any partner agreements in place and they're having issues?
Issues, it's always harder when there are issues, right? Because whoever brings up let's go to an attorney and document this is suddenly the bad guy, even when they're not necessarily the cause of the issues. But they can say they heard an attorney speaking here on GMAP, and maybe we should try to, right? Let's blame GMAP. I always tell my clients to blame me when they have to go to their partners with things that the partners are going to get upset about. My attorney told me.
Yeah, exactly.
But it really is, try to get your partner to sit down with you and say, look, we're having some issues. We've got some foundation documents we didn't do at the time. Let's go out and find a lawyer to help us try to work through these issues, right? So to some part act as a mediator between us and document whatever we agree to so that we can avoid, being at log jams with each other or only communicating by email because we're so mad at each other, or fighting about, hey, is this a really good opportunity or that the better opportunity? It's any relationship. You want to try to keep that communication going even through the tough times. And the ability to say, let's go out to a third party to help us navigate some of this can be really powerful.
And do you recommend any different practices or any different methods when you're dealing with people who are in business with family members, whether it's a father, son, or anything like that?
A little bit, in that those relationships, because of that family connection, they're going to be a lot less willing to document because, we're family, we'll figure it out. And if you ask any business lawyer, they can tell you any number of horror stories about families that didn't work it out. I've got one that they were fighting over the family photos after the parents' death, the children were, and they spent tens of thousands of dollars in litigation costs to fight over who gets the original photos. And we were at one hearing, and our judge looked at the parties, the children, and said, think about how much you've spent on attorney's fees. How much would it have cost you to copy these books 2 years ago when we started this fight? So, yeah, it's even more important when there are families, and that's really one of those times when having an attorney come in as the third party to say, I know your family, you're probably not going to ever need this, but just in case, or, yeah, it's dad and son, but the son gets married, and dad, do you really want to be dealing with your daughter-in-law about your business if something happens to your son? So it's that same discussion that I would have with husband and wife is, yeah, there's that special kind of relationship there, but that doesn't mean that we should act less professionally and not take care of our business like a business.
So then in the case that the business is multi-generational, you do recommend having agreements in place for when the business passes it down from hand to hand?
Absolutely. We had one case where it was a father-run business, and it was the next generation was taking over because dad wanted to go sit on the beach and drink Mai Tais. But the son really didn't have the work ethic he needed to be running this business. I mean, he'd show up when he showed up at all to work in a T-shirt, flip-flops, and shorts, which might be okay
which
in
both of us are
Hawaii.
wearing right now, by the way.
Yeah, all right, that's fair enough. You're not in the office. It's all good. But not so much in a very professional environment in the Washington, D.C. area. And it was ticking off the employees who were starting to leave, who had also been there for decades. And the dad had to step back in and take over control of the business again to save it. So, yeah, especially when it's handing down, so you sometimes really, really need that to protect the longevity of the company. If the kid gets in over his head, if something happens to the child, can the parent pull it back? If they're working at the same time and the parent starts having some health issues, how does the child get control of it so the company can keep running, keep making a profit, and keep returning benefit to its owners? and obviously the people it's servicing.
So what about an event where maybe the business owner's getting older and they want somebody to run the practice or run the business after they can't anymore, or maybe they want to retire, but maybe they want someone to run their business so that it's still of benefit to their family, their wife or kids, but maybe their kids aren't able. Maybe they have some sort of disability, or maybe they're just pursuing a career elsewhere. What do you recommend setting up then?
In that case, the business owner is really going to be looking, probably internally as well as externally, for someone to come in and step into that CEO function. So whether or not they give up a percentage of the ownership to entice that person to step into that role, which is likely, or whether or not the ultimate plan is, look, you buy me out over the next 10 years. So the CEO ultimately becomes the owner if the family has no interest in running the business, but now you've got that long tail so the family can enjoy what dad or mom have built over those years. That is one way to do it. And usually, in the best case scenarios, right, there's someone internally who's grown up with the company, who knows the clients, who's interested in stepping up, and the owner thinks they can have that role, can step into the new role. And that way you now document that transition agreement as to how that person's coming in, what that person's getting from the benefit, and what the original owner retains.
Nancy, I think we could fire off like a million more questions for you. I'm looking at the clock, though. We got to roll. I'll give you the final word, though. Is there any one particular thing we missed or a final action you want to share with our listeners?
I think probably the biggest thing for working with a business partner is, remember, it's still a relationship, right? So 95% of the disputes or the issues that arise that end up at my doorstep as a problem and as a litigation problem, which is bad news for everyone except, well, me, the lawyer.
Finally, a lawyer poking fun at themselves. That was nice.
Is really keep those lines of communication open. When you're dating, it's, don't go to bed angry. And that kind of works with your business partner too. There's very few things in business that can't be overcome if you're talking to your business partner. But when you all retreat to separate corners, that's when you start tearing your companies apart. And that's when you start looking at things like corporate divorces. And there's no good from that. So remember, it's a relationship fundamentally.
Where can our listeners find out more about you, Nancy?
You can find out more about me on my website, which is attorneynancyGreene.com. I'm on Facebook as Attorney Nancy Greene. I'm on LinkedIn at ATTY Nancy Greene, because Attorney Nancy Greene's too long for
for Twitter.
And my firm website, which is landcarroll.com.
Great. And we'll have all that stuff in the show notes. And by the way, listener, why not pick up her book, Navigating Legal Landmines? It's Amazon right now. Get that book. I mean, you heard the audio. Now you can dig into all this stuff and get started. And Nancy Greene is with an E at the end, so it's Greene. Nancy, thanks so much for joining us today.
Thanks, Nancy.
Thanks both, Mike. It was great being here.
Oh, it was joy with you. Okay, Mike. So here's the dealio, bro. We got to summarize what we learned. We got to actually hightail through this stuff because we got to get out of here. And we'll do the GMAP Now task. But first, music's back. I want to thank our corporate partners to make this show a reality. I'm going to bang through it for us. Fundera, thank you. They're a one-stop shop loan source. Go to fundera.com. Fundbox is a cash flow accelerator. Invoices due, they'll actually turn the cash over to the full amount until you collect those invoices. That's fundbox.com. Nextiva is our voice over IP phone system. It should be yours too. That's nextiva.com. And then Receipt Bank is a scanning system that scans in all your receipts, ties it into your QuickBooks or FreshBooks or whatever system you're using, so you no longer have that shoebox. That's receiptbank.com. All right, Mike, what did you learn today?
I just never realized all of the implications and legal documents, agreements that should be set up and put in place prior to starting a business or taking on a business partner. Very interesting.
Yeah, I think fascinating insights. I like the you know how you can break a deadlock. She kind of gave some key elements to this agreement when you have it in place. How you can break a deadlock if one side wants one and one side wants the other. And I like this concept of defaulting to who has the most expertise. Have the buy sell out clause in advance to going into a partnership. That's a key. I wish I learned that. I had other business partnerships. I wish I learned that a long time ago. Have the who controls decision making, the controlling provisions, she called it. Have a long-term the kind of the long-term separation strategy that if you go other ways, how are you going to manage that, including non-competition, the non-compete clause. Loved all the stuff she had to share. And there's one more thing we got to share too, my brother. And you know what it is. You know what that is.
The GMAT Now test?
Oh, that's right. That's why they call him the HUD.
Success.
Dot, 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 dot. Dot, dot, dot. I'm ready to beat. Dot, dot, dot. That's right on it. Yeah, this is the task that, listen, if you do this one task, you will grow your accounting practice. It's always in tune with what our guest said, of course. And this one's no different. Talk with your partner now. That's it. I don't care if you have an agreement in place or not. If you have an agreement in place, it's probably time to revisit it. This is the type of document I see get created all the time and sit on shelves. Sit down and revisit it. Ron and I have revisited our partner agreement 4 times in the last 3 years. We keep on going to it. Do the same. If you don't have an agreement, talk with your partner now and get an agreement in place. It's that simple. You just got to talk with your partner. And as Nancy said, don't wait until there's a hostility. If there's an argument, this will now become an element of discord. Wait until the relationship's humming along, and that's the time you bring it up and say, hey, we should really do this to support and protect both of us. Oh my God, there's the bomb. There it is, bro.
That was a fantastic tip.
That was a fantastic tip. I can see you just kind of jazz up about it. Hey, Mike, before we wrap things up, what can people do? What can they do to with our iTunes and Stitcher stuff?
Well, definitely listen to it, but also go to profitfirstprofessionals.com.
Yeah. Well, let me tell you what you can do with iTunes and Stitcher, because I want you more than just listening to it. I want you leaving a comment and a rating. So go to iTunes, Stitcher,
yes.
Google Play, TuneIn Radio, all the podcatchers out there. Wherever you listen, make sure you subscribe. Make sure you rate. Make sure you review. We'd love to have all that stuff. And we'll respond to your comments. The Haludge now is all over this stuff. So,
of course.
You're like, of course. So leave that. Oh, and the other thing that Haludge was pointing to, it's the most important thing, I get why he jumped to it, is we want to hear from you. Here's what you do. Go to profitfirstprofessionals.com right now. Click on the Become button. Fill out the form, and you can become a Profit First professional. What's Profit First? It's a methodology we developed to drive profitability in entrepreneurial businesses. And guess who the entrepreneurs want to do that for them? Their accountant and their bookkeeper. That's you. They want you to drive profit in business. We show you how to do it for your clients. As a result, they'll be more profitable. As a result, you'll be more profitable. All you got to do, again, go to profitfirstprofessionals.com right now. Click on the Become button. Fill out the form. We're off to the races, baby. We're off to the races. See you later.